good?
Yeah.
What's going on, guys? I want to make a video today talking about taxes. So I actually want to talk about this because I've been my brother and I have been talking about it with some of the people in the real estate webinar we have with the citizens, and even the Bhagwan Remy brought it up. He was asking me some questions on his taxes, and I want to make sure kind of two or three senses of why taxes are important and why you guys should pay your taxes. One is going to be mainly for real estate. Next is going to be stocks, which is honestly not as important, believe it or not. And then the last part is going to be for business. So as far as real estate, why you guys need to pay your taxes, because a lot of people, they don't want to pay taxes. So what they'll do, nobody likes to pay taxes, but they don't realize that it affects them when it comes time to purchase a home. Because a lot, the Dodd-Frank Act, and then the laws it makes for that lenders have for giving out loans, there's something called a 60-40 debt to income. So you pretty much can't have more than 60% debt. So pretty much you got to have, especially when it comes to the housing. So think about it. If you have a $2,000 mortgage payment, that is going to be $24,000 a year. So that can't be more than 60% of your income. You won't qualify for that loan. And it's not only counting the mortgage payment, but also your car payment, your credit card bills, student loans, whatever you may have. So you can't have any of that. Well, or it all gets factored. So if you got a $500 car payment times 12, that's $6,000 a month. They're going to factor that in, plus, or $6,000 a year. So now you're at $30,000. You got another $1,000 a month student loan. That's another $12,000. So right away you're at $42,000. And if you pretty much, your income has to be, well, not 40% of it. I'm trying to think. I'm not good at math, but pretty much that amount cannot total more than 60% of your income. So you can do the math to see what income you would need to have that. But that's the thing. And now, where do they get that income? They look at your bank statements. They look at the money you bring in. But more importantly, they look at what you verify or what you report to the IRS. So when you report your taxes, if you're reporting a higher amount on paper, you have a higher income, and that's going to allow you guys to get loans and even do so even at better rates. And I'm gonna make a video on credit and how that's going to affect you guys and help you out. But the whole point with that is that you can have, when you report higher taxes and you pay higher taxes, it's going to allow you to qualify for more loans and give you more versatility with credit, and that'll even allow you to get more stuff, even with cars or anything else. But that's why you guys should pay your taxes, because a lot of people, they don't like it. I've had some people, they'll make $100,000 a year, but they'll only report $60,000, or they'll report the $100,000, but then they'll report a lot of expenses so that they don't have to pay it. That's one of those things too. Even if whether you get cash under the table, you don't report it, or even if you just write off a bunch of expenses, that all those expenses are also going to show up when the bank goes to look at what you're, when you're trying to get a loan. So you got to make sure that you guys don't report too low, because then it'll be hard for you to get a loan. So that's one thing, thinking for real estate, because a lot of people don't realize this till it comes time to get a house, and now they've already reported taxes. They got to pretty much wait a year to make a better reporting, and then they've already blown the money they've saved. So when you put it in perspective, I guess the potential drawbacks of it is, you got to think, you're either going to have, you pay the government, you pay Uncle Sam that higher amount in taxes because you report a higher income. What's going to happen? Pretty much that cash goes straight to the government. Simple as that. This is a bad move. Come on, speed up. Sorry, guys. But that money essentially, I don't know if I can make that. Come on. Sorry, that was the first time I think in a video where I've been dicked in traffic. And look at this guy switches lanes. I'm gonna go Ford Explorer. Thank you. But anyways, so that money would go to Uncle Sam, and you don't have that money. But now when you go to get a loan, you're going to qualify for a lot more money than you would have, and you can now get the home that's either in your budget or a home, get an amount that you're qualified for, because sometimes people make a lot of money, but when it comes to getting a loan, they'll only be able to afford like a $200,000 home. So you want to make sure that's accordingly. But now the other drawback, and this is where you got to think about it, because sometimes it may make sense, sometimes it not. You could qualify for a $600,000 house, let's say, but then let's say you only have enough at the end of the day, or you want to keep it comfortable and get like a $200,000 or $300,000 home. Then in that case, it may make sense to report what you'll qualify for, and then keep that cash, because then if you don't pay the taxes, that's pretty much going to be you have to pay your taxes anyway, but the higher taxes, that'll pretty much be your money you could use for a down payment. So there's the drawbacks to that. Now, into the stock sense, I'll tell you guys now, go get a CPA, go get somebody, get a professional tax person. I have a professional tax person when it comes to doing my taxes for my trades, just because it's a mess, and you really, my guy is very good. He knows how to maneuver and make sure you report it, because sometimes a lot of people don't know, if you're trading the same stock a lot of times and you're opening and closing the same position, if you take a win and then you take a loss on it, you could only report that so many times. Otherwise, because if you can't report a win, a gain, and a loss on the same entity. They're really going to go. So you make $1,000, but then you trade that same stocks and lose $1,200. They're seeing that you already made $1,000 on it, so you will get taxed on it. And now I've done that before, and if you have a good CPA, they could find a way to make it wash. But at the same time, I just say you guys get a tax advisor, and understand too, when you guys are trading, it's just like in real estate. If you buy in any type of business, if you take money to make money, essentially you make money off of capital. That's why they call it a capital gains tax. After in any 12-month period, you have to pay taxes. So the longer you could hold the asset, the better. And just understand, capital gains taxes, depending on how much money you guys make, you're going to get put in a bracket that's going to be anywhere from like 30 to 50% of your earnings. So take that into consideration when you guys are trading and looking to make money, and make sure you guys really pay attention to taxes and your reporting, and have someone who handle it. Otherwise, I've had a brother, he got hit with like a $7,000 tax bill, and he was trading on like a $2,000 account. So make sure you guys watch out for that. So I'm not going to go into that much, because honestly, I believe you guys should just get a professional tax advisor. But as far on the last end is business now, because if some of you guys have businesses, make sure you guys have corporations set up, and that you want to make sure that you have some pass-through, where the taxes, you could either have the taxes you could pay it on the company, but then if you own your own LLC and you don't have it passed through, you'll essentially be paying taxes on your company's earnings and your own earnings when you pay yourself. So make sure you set it up, design that. But again, professional tax advisor. But that's not the one thing. I want you guys to, if you own your own business, make sure you guys are accounting for taxes and saving that money, because at the end of the year, you're going to have to pay it. But then another thing is, if you guys ever get paid and you have the opportunity, everyone doesn't have to pay taxes, and sometimes you'll have the opportunity to defer the taxes. Depending on the situation, more instances or not, I actually suggest, this guy in front of me is a jackass. I suggest that, of course, it was a woman. No, I'm kidding. I suggest you guys pay the taxes while you know what it is, because not only, factoring in inflation, but if you defer taxes, your tax rate might go up. So better to pay what you know. And then in other instances, you may, depending on what you're paying taxes for, if sometimes you guys are given assets, or even if you guys ever get stock options for your company, you might want to pay the taxes up front than down the road. I had a deal where I worked with a company, I set up some infrastructure stuff, did some consulting, and they paid me in shares. And they paid me in shares, instead of getting paid about $50,000-$60,000 for the work, they said they would pay me in shares. And now the stock at the time was at $4. So I pretty much had the opportunity. You could either pay taxes when you sell the stock, or you could pay taxes all up front once on the amount that you receive. This is one of those instances where it's better to pay the taxes up front when you receive it, especially if you think the asset's going to grow. Because in that case, the stock, I got issued that stock when it was at $4 a share. The stock eventually went up to about $150 a share. So that's one way that I made a lot of money. But the thing was, where I saved a lot of money was paying my taxes up front. So I only had to pay taxes on that $40,000. So when that amount balloons to over 10 times more, when I go to sell the shares, I don't have to pay taxes and it's done. So simple as that. So you guys see the 3 instances. Moral of the story, don't be afraid about taxes. Make sure you keep track of them and actually pay them. And you know, there's a cost benefit with everything. There's give and take. Understand that taxes really aren't that bad. And especially if you know how to use them and you factor them into a long-term plan for you guys building your portfolio of assets, like you're saying, you know, ranging from stocks to real estate, even to companies and who you work for. It's all very important stuff, but you know, planning is the difference. It could save you a lot of money and headache down the road. And again, too, you know, another point, I'm just some dude on the internet. Get a tax professional, okay? I have somebody do most of my taxes, all of my taxes. So I, you know, at this point, I don't have to handle it. But as you see here, I do have some knowledge of how things work with taxes, and that's something I would recommend, you know, so that one, you're not really oblivious to the whole situation, but still have a professional who can do it for you and help you out with it. So leave it with that. Hope you guys enjoyed it. You guys have any questions, you could ask me if this was helpful. You know, and I'll tell you, this probably won't be helpful till down the road for some of you, but you know, don't forget this. I want main goal, actually another one, I want you guys to be able to get houses. Honestly, I want all of you guys to be looking to build portfolios. Portfolios go beyond stocks. It's all your assets. So looking at houses and take this stuff into consideration, and you guys would be surprised. You know, a lot of you would be able to qualify easier than you think, and a house isn't too out of your reach. So think about that stuff. Pay your taxes. Stay in school.